We're clearly right up there. You see that? Boom. There's your signal. It is a warning of what is coming, and there isn't any human being. Yes, this is the indicator. It just happened on Friday. This is a huge, huge warning.
Stop what you're doing. This could be the most critical message you'll hear all year. Lynette Zang is sounding the alarm. Hyperinflation may already be here, and the financial clock is ticking fast. What's the shocking signal that could flip the economy upside down? Why is this recession unlike anything we've ever seen? And most importantly, how can you stay ahead of the chaos? This is your wake-up call. Watch now. Your financial future depends on it.
Today, I consider this a very, very critical video since there was a major disinversion pattern shift that happens. And this is always a foreteller of recession. And what is a recession? A recession is a deflation. And there's only one way to fight that, and that's with inflation. So between that and other things that are coming up, I think that I feel quite confident that this coming year, we're going to see a lot of very visible inflation. Beyond that, I think that it'll become obvious maybe toward the end of next year or into the following year that we are in hyperinflation, which I think has already started. So it's like critically important to get everything set up. Let me show you what's going on. I showed you this when it happened, the first 210 yield curve disinversion. Now, let me just kind of back up for people that are new to this and explain what a yield curve inversion is, which is when shorter term rates are higher than longer term rates, which kind of is illogical. But when that disinverts, when the longer term rates become higher than the shorter term rates, then that's when the clock is super ticking. So it could be obvious within the next 6 months. We're in kind of a weird period of time where we have a new president coming in. So there's tons and tons of hopium that's going on, but they've already been warning you about the inflation that we're going to be seeing. So they're trying to head some stuff off the path. But this was back in June when they started to talk about the recession signal to watch. This is not going to be just a normal recession because of where we are in this trend cycle. This is why it is so critical. But we saw back in, it was really in September, the beginning of September, where the 210 yield curve disinverts. The clock is ticking. I'm going to go on with that, and the warnings are growing. That was just back in the beginning of September. Now, the bond market has its worst week in months with less Fed action seen, meaning dropping the interest rates further, but the Treasury yield has climbed. The 30-year has climbed more than 25 basis points. So the longer-term yield is growing, even as the Fed has begun to cut rates. So I got to be honest with you, the market is disagreeing with the Federal Reserve. Key Treasury spread turns positive with Fed rate cut in view. Yes, this is the indicator. It just happened on Friday. This is a huge, huge warning because typically, we're looking at maybe a 6-month window. Let me show you what I'm talking about. This is the 10-year Treasury with the 3-month. So that's the one that which I'll show you more closely, has disinverted. But as you can see from this, okay, just before these gray bars are official recessions. And remember, the government gets to declare what's a recession and what's not a recession, which I think is a joke, but whatever. But you can see that once it goes above that line and it disinverts, these gray bar recessions follow very quickly. Even this little teeny tiny one that we had in 2020, the smallest recession ever, thanks to all of this money printing. Yay! Let's play central bank. But the yield spread between Treasuries, 3-month bills, and 10-year notes is a proxy for how investors see Fed policy affecting economic activity. It became inverted in October 2022 as the Fed was raising those rates. Now it has disinverted, and we can see that more clearly right up there. You see that? Boom. There's your signal. You don't even need to really know exactly what that means. What you need to know is that it is a warning of what is coming, and there isn't any human being that can stop this train because we have virtually no purchasing power left. And so the normal tools that used to work, I mean, haven't you noticed how many times those talking heads on Wall Street are going, well, this is unusual. Well, it doesn't work like it used to. Well, no, it's not going to, because of where we are in the trend cycle and the tools that they have left. And the markets disagree with the Fed, right? Now, who's going to win? Who's strong enough to win that? We're going to find out. But my bet is, quite honestly, that the markets are a lot more powerful than the Federal Reserve. And the warnings of an impending recession are growing. Make no mistake about it. I don't care what it looks like out there in Wall Street land. Their job is to keep you in the markets to steal your wealth. My job is to help you understand what's really happening, translate this financial noise, and enable you to make educated choices that put your best interest first. What a concept. Now, this just came out this morning, so that's why you see it in this form. T. Rowe Price raises the prospect of a 6% Treasury yield on fiscal risk. Well, what happens if that 10-year Treasury goes to 6% and all of the debt that's based on that yield, that interest rate, also does that? First of all, the banks are sitting on a mountain of debt that, as those interest rates go up, the market value plunges. They're already there, including the central banks. They are all insolvent if there is a major run on the banks. The fact that they can declare it held to maturity so that makes it look like that doesn't change the facts. Additionally, when you see all of that new debt that must roll over, and there is a major wall, whether it's government, corporate, or personal, individual debt, that is rolling over this year, next year, the following year, but rolling over into a higher interest rate environment. And now you have this battle going on additionally between the Federal Reserve and who? Oh, the markets. We're going to see who flexes their muscles and who flinches. But what we absolutely know from history, that whether you're looking at deflation, people always go, wow, what about deflation? Deflation is prices going down, whether it's stocks or real estate or anything, right? So you can see how gold and silver perform through either deflationary events.
Thank you for joining me today. If you found this video valuable, don't forget to hit the like more button. It helps more people discover this critical information. Be sure to subscribe replying to the channel and turn on the bell icon so you're the first to know when I release new videos. Together, we can navigate these challenging times and secure a brighter financial future. Until next time, stay safe, stay prepared, and keep your wealth protected.